Okay, welcome everyone. My name is Tim Ogden. I'm the Managing Director of the Financial Access Initiative at NYU Wagner and the host of the faiVLive, a regular series of conversations that we have on topics related to microfinance, financial inclusion, small firms, small firm finance, and related topics, household finance in particular, as well as small firm finance. This faiVLive is part of a learning community sponsored by the a learning community sponsored by the MasterCard Center for Inclusive Growth. And the goal of these faiVLives is to bring together a group of people who care about and deeply involved on topics of household financial security and small firm finance to help us learn from each other. And as such, the faiVLives are not traditional, we're going to present a bunch of things and throw a bunch of things at you. These are conversations. And the conversations, of course, really revolve around the people, the panelists that are participants with us today, but they also revolve around the participants. So right from the very beginning, I want to be very clear. We want to hear your questions and comments. Please do use the Q&A and the comment function to add your thoughts, to add your questions. We'll be addressing those throughout. If you ask something, I don't want to discourage you from doing this, but if you ask something or say something particularly interesting, I may in fact bring you into the conversation directly, not just by reading your question, but turning on your mic and asking you to comment. So with that as background, let me launch into today's topic, which is about microfinance. The industry meets the pandemic 2 years later, 2 years from now. So the genesis of this conversation is a faiVLive from 2 years ago. Right after the start of the pandemic, which was about this emerging crisis of the pandemic. And I feel strongly that when one is wrong, one should take an opportunity to go in public and say very clearly that one was wrong. The genesis of that conversation was my concern that the pandemic was truly an existential crisis for the microfinance industry. That this was not a crisis like anything the industry had ever seen before, that the industry had done a pretty good job of weathering crises like the 2008 financial crisis or the Asian financial crisis in the past. But this was different. And I really was very concerned that this was different because it was a crisis that was affecting both sides of cash flows or capital flows for MFIs at the same time. Pandemic restrictions were going to affect customers and their ability to manage their daily financial lives and therefore generate repayments. So that was going to affect the cash flow and liquidity of MFIs. At the same time, the financiers, the capital providers were being stressed on a number of dimensions, and they were going to pull back. And so MFIs were both going to be cut off from capital and cut off from cash flow. And that does not lead to long-term longevity. And I was deeply concerned that the industry was young enough, as well as the flow of belief about the impact of microfinance coming out into the crisis, that participants in this industry, regulators, central banks, as well as capital providers, were not going to take it seriously in its potential impact to the industry. 2 years later, it looks kind of silly to say that this was an existential crisis for the microfinance industry. The industry has weathered this crisis, from my perspective, certainly from what I believed, surprisingly strongly. And in the big picture, I attribute that a lot to people behaving in ways that I did not expect them to. First, we've seen that MFIs themselves have been dramatically more nimble, agile, and innovative than I gave them credit for. And so I want to sort of come out here and say, so many of the people in the industry that I've been speaking to over the last 2 years, I dramatically underestimated these organizations and their leadership and their field staff and what they are going to be able to do to work through a crisis like this. At the same time, the thing that's probably the most surprising to me is the progress the industry has made is that regulators and central banks and financiers around the world really did recognize that microfinance was critical to the poorest and that they needed to do things. They needed to take action to protect these institutions. And that took the form of things like imposing payment moratoria, which might not seem like it's a great thing for a credit agency, but a structured moratoria that allows everybody to understand and allows the accounting for a moratoria and payment without suddenly having to write off a bunch of loans, things like that matter positively a lot. Many central banks and other institutions provided liquidity facilities specifically for MFIs around the world so they could weather the crisis. And for the future, that's probably the thing that I'm most encouraged about, is the microfinance industry has, over the course of the last 30 years, gone from a curious sideline that was primarily the domain of philanthropy and social investors to a recognized, legitimate, and important part of the financial systems of many, many, many countries around the world. And that means the quality of decision-making, the attention, the resources, that there's potential there. That being said, I have to remind you that I'm Tim Ogden, the guy who can find a black cloud inside of every silver lining. And so part of the reason for this conversation is I remain concerned. I remain concerned about what happens next, because I don't think the crisis is over. I think we've done a really good job with the current environment, but there's a lot still to come. We're not done. And not just because of the virus, but because of the stresses that this has put on a lot of MFIs around the world. Now, to document that process of surviving the crisis, a couple of years ago, in conjunction with Daniel Rosas and Sam Mendelson, we started this process of creating something called the Sentinel Project. And the idea of the Sentinel Project was, often when you get a crisis, the literature is 3, 8, 10 years later, somebody goes back and interviews all the people they can still find who lived through it and asks them what happened and what they did. And there's a lot of bias in a process like that. So what we wanted to do was go and talk to the leaders of MFIs as they were making decisions in the crisis, to hear about what choices they were making, what challenges they were facing while they were going through them and while the outcomes were still unknown. And so we recruited a group of researchers from around the world, 3 of whom are joining us today. Dwijraj Bhattacharya from Devara in India has been interviewing MFIs in India for the last 18 months to learn what's happening there. Katarzyna Pawlak from the Microfinance Center has been talking. So Katarzyna is the director, the CEO of the Microfinance Center and a network of Eastern European primarily and Central Asian MFIs, and has been interviewing some of those specifically for the Sentinel Project, but also has been in contact across the region with MFI leaders and funders as that region copes with the crisis. And Barbara Magnoni, who has long-standing relationships with many, many MFIs and many people in the sector in Latin America and around the world. So I asked the 3 of them to join Dan and I today. Dan is a FAI affiliate and a senior microfinance expert with the European Microfinance Platform. To start this discussion. So again, we want to involve you. Please do use comments and Q&A throughout. But now that I've given here's what I thought would happen, here's where I was wrong and why I was wrong, I want to turn to some of our Sentinel interviewers who are experts in their own right. They had thoughts about what was going to happen. They had concerns. And to ask them, what did you expect and what has surprised you about the last 2 years? Barbara, if it's okay, I'll start with you. When the pandemic started, what were you most worried about? And what surprised you about what has happened in the last 2 years?
Thanks, Tim. So I was most worried about clients because that's kind of what I do. I worry about clients. And I was worried about clients because of lockdowns and because of isolation and, figuring out how they were going to be resilient and bounce back. And your point about sort of everybody else getting it quickly and responding to that concern quickly, I think can't be emphasized enough, because when the financial crisis hit, nobody really got it quickly. And you didn't see this kind of response. And I've been reflecting on that. And I think it has something to do with the fact that we were all living it. And it was much easier to understand because we were personally affected every single day. So we talk about the climate crisis, but we go into our kitchens and turn on the water and it's always there. And so we don't feel it in that same way. But when this happened, we all were locked down. We all were struggling. We all had access and communication issues. And so from the loan officer to the manager, to the CEO, to the provider of liquidity, to the supervisor, everybody got it very quickly and understood very quickly what needed to be done, as you say, to protect those clients. And that was really the focus of the response. And I don't think we could have predicted that because none of us, all of us were in shock anyway, right? And so how could we have predicted the way that human response was going to act on that? I think what we did see, and we have seen in the micro enterprise sector for so many decades, is the resilience and the ability to bounce back of the end customer. And if we had just sat down and thought about it a little bit, I think that would have, sort of come through. But obviously they needed that extra support that was happening. And so that was very important. I was incredibly surprised, not just by the agility and resilience of all of these stakeholders, but of the clients themselves and their ability to pivot and continually pivot as they kind of navigated this difficulty. And like you, I'm concerned that, it isn't over, that they're still smaller, they're still weaker. Many of them have stopped doing what they were doing naturally, and that we are facing really uncertain times and that there's a lot more uncertainty ahead. So I'll stop here and then we can kind of go back to some of the stuff.
Absolutely. Dwijiraj, India, probably the biggest microfinance market in the world, depending on how exactly you count things, has lived through some crises, several crises throughout, and is a source of a lot of innovation in microfinance. What were you and your colleagues at Devara expecting, and how have things played out that have surprised you?
Thank you, Tim. So I think when the pandemic started, we broadly had three sets of expectation. Firstly, we thought, like Barbara was also mentioning, that the hardship on the clients of the microfinance and the bottom of the pyramid customers, who are primarily the stakeholders that we had thought of advocate for as well. So we thought that this was going to be quite an existential threat for them to begin with, rather than just start at the financial system itself. And we saw a lot of resilience from the clients, and at some level, we also saw a lot of government support. Like if you look at India, there were cases where people were traveling thousands of miles on their road in order to just reach back to their native place because of the entire urban-rural migration, etc. So we see that the clients, the first thing that we expected was this exodus of people out of the cities back to the rural hinterlands, which basically distorts every collection model that is out there, because most of the collection we're talking about is physical in nature. So that's sort of step one that we're looking at. The step two, we thought what was going to happen is just a recurrence of demonetization. So as I know, I believe you will recall that in 2016, what happened was that overnight, the largest currency notes were just taken out of circulation, and that basically stopped all form of exchange of goods and services and payments, etc. The pandemic pretty much did the same thing, except instead of taking out currency, what happened was you did not really provide an opportunity for people to meet and exchange goods and services, etc. So given that, and given the digitization, and there's still a cash economy and digitization hadn't really kicked off, we expected that that's going to be the next major bottleneck insofar as how do you even make money? How do you even transact? And what we saw was three things that really helped. First was the agility of the microfinance institutions. And by this, I mean innovations happened at every single level. So how to transfer cash register, how to transfer cash box from one place to another, to how to even reach out to clients. So when we are talking about strategic decisions at the management level, then to very small client relationship building measurements and innovations that happen at the loan officer level. So that's perhaps one side of the coin. The second side of the coin was with the entire regulatory intervention, which is what you were mentioning in terms of the moratoria. I think the moratoria really helped. The moratoria, given that the first 3 months, there was a moratoria in India after the COVID-19 pandemic hit, and that later got extended to 6 months. what happened was that the clients were able to conserve cash to an extent. And because of that conservation of cash, what we see is that as we progress down the time frame of the pandemic, people are able to repay to an extent, and repayments are shooting up. So although it was a blanket moratorium, a lot of people started repaying after the second month or third month or fourth month. And we see a lot of people just coming in. And I think that moratoria and a lot of fiscal support also went in, targeted fiscal support towards the MFI. So that definitely did help. And the third thing I would say is beyond both the structural aspects, which is the microfinance aspect and the regulatory and fiscal policy aspect, were clients. Clients were tremendously innovative when it came to switching their day-to-day jobs, because we all know that agriculture, for example, was something which was exempted and people could carry out agriculture. So all of a sudden, people who were engaging, who were taxi drivers or who used to do non-essential activities which got banned, they all of a sudden started pivoting towards these aspects which were in play, and therefore they were able to generate cash flows. So what we see mostly is that there was a lot of pivot that happened from all these three actors, and that really helped. In terms of looking forward, there are still concerns, specifically in India. Over the last 1 year.
Stop you there, Dwijraj. We're not going to start talking about going forward yet. So we'll come on to talk to that. I want to bring in Kasha to talk about the Eastern and Central Asian perspective, because it's different from Latin America and India. The organizations are by and large younger, but the borrowers are also by and large larger. And the sizes of loans are larger. And so that does sort of present a different challenge. Kasha, when the pandemic was hitting, what were you thinking? What were the members of the Microfinance Center in your network thinking? And what surprised you about what's happened in the last 2 years?
Yes, I agree totally with what Barbara said, that this affected all of us. And I remember still my colleague coming from the field in Romania, 13th of March, and actually her flight was delayed, and the lockdown was just announced the same day in the midnight. So I think we were all taken by surprise, including our members, ourselves, and we were, in this situation where you have to act now and you are not prepared and you don't have ready solutions, and we are all in the same boat. So I was super concerned about the fact, reflecting on previous crises, especially 2008 crisis, where each MFI worked alone, or we only have groups of few MFIs working together to help clients or investors, everybody trying to kind of, we have this saying in Poland, just to rescue your own butt, sorry for the language. And I was afraid how we are going, in this situation when we are all locked down, to coordinate our response when we see all these domino effects, everyone affected, and no time for coordination, no time to meet and discuss, to negotiate. And I think maybe this is actually what helped us, because we were all in the same boat, but kind of, glued to the surface without much kind of ready tools to respond. So we had to really act from the point of where we are currently are sitting, and take into account the needs of different stakeholders. So I would say that this empathy, kind of appeared out of the blue, that nobody expected, and it was amazing to see. I remember, very quickly we gathered members and ran some training on contingency planning, and members tried immediately to talk to clients, not waiting like it was in 2008, but trying to get better understanding what's going on. It was even before regulator, and very soon regulator enter, and it was really different, because in 2008 nobody cared. Everybody cared, to just take care of their own business, of their own interest, and I think this was something I was really worried about. So the regulator came, but also came in with a different approach. Again, I think this empathy and this lack of tools and feeling it, themselves, giving a lot of flexibility. There was moratorium, but also when you look across the countries, there were also other measures. And when I've been talking with MFIs, they were actually underlying this flexibility, that first of all, you always could start with the client, and the flexibility and scope of different measures allow you to fit the right measure to the right person, to have this customized approach and have a kind of a strategy together. And of course, the other element, which I think also some of the MFIs we've been talking with reflected, it was like, this very fast running train that will hit the wall, like in 1 week, if you don't manage to agree with the lenders, because you will get into liquidity crisis. And I remember, and you remember as well, I mean, very quickly the sector came up with this initiative, like MIB signed the MOU, and in the past we also used to have different initiatives, but then I was thinking, is it we will have time to trickle it down to the field, to really, to the moment of decision making, because the decisions have to be made like every minute, every hour. You have to adapt. I really like one of the sentence in one of the interviews I carried out. Somebody mentioned, we were just making decisions and then we were like improving them. We didn't have time to think over those decisions. You had to act. It's like acting and I think this agility, this being adaptive and all the time looking for, okay, maybe this is not the best solution now, but this is the best solution I can think of, taking into account different factors, and I am going and making this decision, even if it's a tough decision, and I am improving it. And also, I think the lenders really presented here a great attitude. Everybody confirmed that they were very open, even if there were some formal or administrative barriers, to some contracts, agreements. They found ways in which, even by gentleman's agreement, they could ease the conditions or offer some waivers. So I think we somehow, managed to have this concerted approach, but we didn't have a conductor. But somehow, I think this focus on the need and thinking through this ecosystem help us to make the best choices, also taking into account our limited knowledge and limited access to tools. So I've been very positively surprised, how each of the actors responded, and how MFIs, how the managers, how the staff responded, colleagues being sick, other colleagues replacing, very quickly adjusting to the new sanitary regimes, to new modes of operating. Of course, I would say, maybe we will talk a little bit later in a minute about it, those that started some changes beforehand, it was easier for them than for some others, but generally I'm really surprised, and I'm really proud, of the sector, that in spite of all the challenges and difficulties and the need to make fast decisions, we were making those decisions really thinking about this domino and this interrelationships between different stakeholders.
Infrastructure has really proven valuable, and not necessarily the formal infrastructure, but the informal infrastructure. I don't know, organizations like Microfinance Center and EMFP and others, that's not really informal, but it's not sort of direct binding commitments. But as you were saying, people really took this seriously and working together. Dan, I want to turn to you, both from the perspective from the European Microfinance Platform that sort of reaches globally, but also, like, you've always been my go-to guy on the finance underlying all of the numbers. And one of the ways that all banks make it look like they're doing better in a crisis is you reschedule loans, your PARs creep up, and then, you reschedule those loans and your PARs go back down, and you sort of do a little bit of financial engineering here. And that can work in the short term, but it never works in the long term. It creates potentially even bigger problems. And so, Dan, from the finance of microfinance perspective, when this launched, how concerned were you about the underlying finances and what was going to be going on underneath the covers, and how has that evolved? What have you seen And again, of course, anything that's particularly surprising.
Yeah, no, it's I was actually looking back. I think it was the second half of March, right around the March 20th or thereabouts, that you had reached out to me, 2020, right, March 2020, and saying, "Oh, what are you hearing? What are you hearing from investors?" And I was actually quite calm about things. It's like, well, I had spent a fair bit of time going back to the financial crisis, studying MFIs that had dealt with crisis. So this was not kind of new. The concept of being in a crisis wasn't new. What the difference was, okay, well, this is global. But I was actually more relaxed than I rightly should have been. I actually saved the screenshot. I'll attach it here in the comments so people can see what I thought, 2.5 years ago. But what was really interesting for me, so once we really started getting engaged, started talking more to investors, it wasn't just the fact that people were feeling it, although I think that made it more immediate. I think there was another really important element, is that back in 2008, 2009, no one in the investor community had dealt with this in microfinance. What does it mean to reschedule loans? Well, I mean, credits, not loans of clients, but loans of investors to the MFIs. What does it mean to get into agreements to extend loans, or how do you negotiate with other investors who are, a single institution might have 10 or even 20 investors at a time. Some cases, I've seen institutions that have had close to 50. And how do you manage that? How do you in a purely communication sense, how do you maintain agreements with that many organizations, each of which has its own, even down to the point of your point of contact isn't necessarily the decision maker at the investment fund. It goes to their credit committee, goes to their risk management unit. And so there's a lot that needs to happen. And so the fact that when, in 2020, if you look at the funds that were active at that time, the fund managers, all of them or nearly all of them had already been around and active during the financial crisis. They all dealt with it to one extent or another. So for them, that was the first time, and now this was second time dealing with something. And I think that made a big difference. It made it a lot easier to then, very early on, already in March, investors were getting together, having calls. Sometimes the MFP was involved. Sometimes we were just helping them to convene, but we weren't involved in the discussions themselves. But to say, okay, we're going to have a lot of requests for loan extensions. We're going to have a lot of requests for, kicking the can down the road. But okay, under what conditions are you going to kick it, and how far? Mm-hmm. And just create a process for handling it smoothly. And that happened quite early on. And there were two major initiatives investors put out. Both of them, I think, published, I want to say, in late April or so. And I think they made a big difference, not necessarily in that it was a formal process that was binding, but it was kind of an agreement among a relatively small group of investment funds. I mean, you figure there are roughly a dozen major funds and a number of smaller ones, not counting the public DFIs, which is slightly different. So if you can get them around the table and they all agree to a current, a framework, it makes things a lot easier. And I think that a lot of my concern once I started looking at the numbers was about liquidity. What's going to happen, not because they rescheduled the loan of a client, not because they kicked the can down the road, but hey, I got to pay salaries for the staff. I can't collect anything. There's, I'm on the moratorium. It covers, all of my portfolio, for example. How do I just operate, purely on a cash basis? And my biggest concern was that potential liquidity squeeze on the institutions could just easily drive them out of business. And that liquidity squeeze, I think we published a piece, I want to say in May of 2020, might have even been late April, looking at, okay, if you look at the financials of typical MFIs, and you look at the cash available, how many months can they operate if they have no inflows? Mm-hmm. And it tended to be at least 3, in some cases 6, so some level of comfort. But what was interesting was the most immediate thing that would push an MFI into illiquidity was having to repay a loan to an investor. And those loans turn over really quickly. Mm-hmm. And so I think the fact that investors recognized it and came up with sort of a commonly agreed framework to deal with it, is kind of an underappreciated aspect of dealing with a crisis. I think if that hadn't happened, if this crisis had been dealt with the same way that 2008, 2009 was dealt with, we would have had a much, much bigger disaster at the institutional level. I think that's almost without a doubt.
So
Tim, can I add something to that? Just because I think that's right about the liquidity, but I think there's sort of an overarching factor above that that also played into it. So one is what Dan was saying. They know how to do it. They've been there before. They were relatively capable and agile, but I'd like to be a little more cynical and say there was a lot of global liquidity out there, and these funds had to place their money. They couldn't sit on it because they would lose money if they did. And so that's very different from 2008, 2009. They had money to put to work. Governments had money to put to work, and were putting liquidity into the market. And, some of these other DFIs were also putting liquidity into the market to kind of, stopgap some of it. So that was contextually very different from what we experienced in 2008, 2009. I think going forward, we're going to see that dry up a little bit, and it's going to change, but yeah.
Well, I mean, we'll come to that because obviously that is one of the big concerns. But Barbara, I also wanted to talk about something that Dan mentioned there as well, which is MFIs paying their staff, right? There's a liquidity thing, and staff changes here. It isn't just that the fact of how do we deal with the customers. The job of working for an MFI changed radically, very, very suddenly. And anybody who's had to run a large organization knows, like, you hire people with skills to do this job that they're in. When you suddenly change what that job is, there's absolutely going to be a mismatch between the people you've got in place and the job that needs to be done. And that's not just a problem for management. That creates a lot of stress on people. And many of the employees of MFIs aren't super high people with lots of resilience and savings in the banks themselves. I know that's been a particular concern of yours, and especially the gender lens on that. When you look at how MFIs have reacted on the staff side and how staff have reacted, what really stands out to you?
I think it's nuanced, and I'd love to hear from everybody, because I think each country is different and each region, maybe not regionally, it's more a country level issue. Just structurally, unions, played a factor in some of the interviews we had where they couldn't get rid of certain staff because they were unionized. So they got rid of other staff that was more productive, and they had to take the unionized workers and kind of reshift their jobs. And that was incredibly difficult, and put a lot of pressure on that staff, to kind of, get off their butts. They were sitting in offices and branches comfortably approving loans, and all of a sudden they're sent out into the street, with masks and shields to try and get new clients. And that was like enormously disruptive and difficult. So it's going to depend a lot on clients. But my sense from the interviews that I had is that everybody tried to retain as much staff as they could, to focus on productivity as much as they could, and to help staff adapt to working from home as well as they could by providing, chairs and desks and infrastructure and computers, and letting them bring computers home and things like that. The emphasis that I always place is on women, because women did bear the brunt of that shift. And by working from home and dealing with kids who were in homeschool, dealing with family responsibilities, with elderly family members, with all of the extended families that they had to deal with on top of their job, on top of the pressures of their job, and what, Kasia and Dan both kind of referred to, this sort of hectic, crazy responsiveness that could be nicely called agility, but it was also very chaotic, was a lot for a lot of women. And, we did address it with some of the sentinels that said, I'll just give you an example of one that said that 60% of women were leaving for personal reasons versus men. One interview that I did kind of separately on a separate project talked about the percentage of women, this is in Nicaragua, women staff fell from 62 to 50 within the year. So women left the workforce, and that burnout probably overburdened female staff over men, both on the field level and in kind of management positions.
And it wasn't just in Latin America too. We heard differential attrition of female staff from a lot of Sentinels in a lot of places. And, I would commend to everyone a piece that Barbara wrote about the long-term impact of the future leadership of microfinance that has always had this specific gender lens. But if you differentially lose your women employees up and down the scale, that has a very serious long-term impact on how many women are going to be in leadership positions 5 and 10 years from now because of differential impact. And you can see Barbara's post on that on the Sentinel Project, and she's just put it in the comments as well. The time always goes faster than I expect. And so I'm going to pivot here a bit away from the 2 years of the past and to the 2 years to the future. And I think part of the way to do that is to talk about digitalization. And specifically, one of these ideas that was out there is like, the pandemic's going to help accelerate digitalization because we have to interrupt all these face-to-face interactions. Digitalization is going to be the wave of the future. And Devara did some specific lots of conversations with Indian MFIs that you and I have spoken about, this sort of wave and change of what's happened in digitization. Would you give a quick overview on how Indian MFIs, who, let's be honest, probably have better access to IT talent than most other countries where microfinance plays such a big role. How did Indian MFIs sort of take on digitization, and what did that look like for the customers and their business models and their processes?
So I'll actually start maybe another 5 years, 6 years ago, 2016. I'm going to go back to demonetization again, because I think that's where digitization became a huge thing. Like when there is no cash in circulation, you have to pivot towards digital money. So we saw a lot of MFIs actually starting a drive towards digitization at that period. But once you see remonetization, once you see the cash coming back in, we see that there is not really much of trust that exists on the digitization front. However, between that time period of 2016 and 2020, we also see that the mobile penetration, bank account penetration, and things like that, that actually allow you to carry out digital transaction, that went up rapidly. And quite so much on the back of policy initiatives, to be honest. But there was a rapid increase in mobile penetration with their companies coming up that were actually giving you smartphones for free, and not smartphones for free, but connections for free, etc. So we see that the infrastructure, the backbone of the infrastructure was already there. What wasn't there, and these are the specific challenges that happened, or rather that MFIs discovered, was that their record keeping was dismal. In most cases, what they saw was that when they were even trying to even before digital transactions and repayments, even if someone wants to call their clients and because no physical meetings are happening, someone wants to call their clients and ask them how they're doing and if they need any help, that's next to impossible, because mobile number records, etc., they were just all over the place. Nobody had correct numbers, etc. So those presented significant challenges. Now, even if I'm to ignore those challenges and just look at the enabling factors that existed, what we see is that during the initial phase, there was a huge uptake when it came to the endeavors towards digitization. And in India specifically, like you were mentioning, it's much cheaper to actually get the entire system digitized, and there is access to a lot of talent. And the infrastructure to a great extent is also present in even rural areas, etc. So given that within the first 2-3 months of the pandemic, we see huge thrust towards digitization. So one of the Sentinels already had digital partners and already had onboarded a digital system. So they were slightly ahead of the curve. The other Sentinel was thinking about it, but hadn't really started anything. So they were just there. And there were certain entities who were just not thinking about digitization altogether. And they were caught behind the curve to an extent. But all of them, like the moment the pandemic hit, what we saw is that there is a huge thrust towards digitization, and there we see systems becoming live and digital repayments starting within the first 3 months, and they sort of peak after 6-7 months, and then it dies down. It dies down primarily because after 6 months of the pandemic, there is no moratorium, and people have to start repaying, and it's difficult to ask them to repay over digital means. So people are just going back and starting to talk about, okay, I'll send my loan officer there, and just collect cash. But what happens then is, after around 1 year, not a little over a year, the second wave hits. And this time around, you don't really see these sort of regulatory, you see some amount of forbearance, but not a lot, but there is no moratorium. And villages are blockading individuals from getting in, and community meetings are just prohibited. And we also see a lot more loss of human life at a larger scale. So because of that, all your cash interactions are slowing down. So what happened during that was that, so it peaked in around September, October, the entire digitization process, I would say. And then it fizzled out. But again, in May, it became a huge factor. So May, June, July, what we saw was that most of the Sentinels, they started recollecting, and the number of users went up a lot, and people started repaying a lot. So earlier, once the initiative, so the peak of the users, if you look at, there are 3 distinct peaks. The first peak happens when the launch of the digital portal happens, and there is communication about, okay, this is something we have done, etc. So that's something around, say, June, July 2020. Then October, November is when another peak happens, because now the moratoria has ended. So people are just revisiting, okay, what is happening? Let's figure out, can I repay using this? And then we see another peak. But post that, what we have seen is that we are again going back to the physical mode. There is still a decent thrust because a lot of infrastructure investment has happened and a lot of capital has sunk. So therefore, we see that MFIs are still trying to embrace digital repayments and digital disbursements. One of the MFIs had actually started complete digital disbursements to begin with. But yeah, so we do see it reducing to an extent, but it isn't really a change that we saw in case of demand. Then let's forget about digital. Right now, that thrust is continuing. And we do believe that most of the MFIs are considering, if not 100% digital repayments, but definitely 100% digital disbursements. So that thrust is definitely there.
So there is a runway, a pathway, not necessarily as quick as it looked like it might have been. And there is going to still be sort of some long-term growth and development needs to be there. And India, I think, is probably a pretty good bellwether for a variety of reasons, as you said, the depth of penetration. Barbara, I want to come back to you on some of these digitalization questions as well. But first, Kasia, Eastern Europe, Central Asia, deeper penetration as well, going into this, a lot more use of technology. How are the MFIs that you're talking to thinking about where digitization goes from here? Is it we know where we're going, or are there still a lot of challenges ahead?
Yeah, actually, I think I ended my short sharing by saying that those MFIs that started these digital initiatives before the pandemic, they had an opportunity to progress on those, but still clients prefer individual contact, right? So maybe we see fewer clients coming to the offices in some of the countries. With some MFIs, it was like 90 or even 100% coming to the offices, and clients were rather reluctant to use digital channels even for repayment. So the pandemic definitely puts incentives to use these digital channels, but we rather see increasing digitalization of back office, of bringing new technology, where institutions are able to offer a wider variety of ways to service clients, being call centers, maybe reducing the number of visits, also from the point of view of reducing this transaction cost to the client. But truly, it's more this younger population which is more eager to use online lending, for example, and this accelerated, especially for consumer lending in different markets. At the same time, we see, I am just reading because I got this information today. We are analyzing our new round of research that when we look at the digitalization, 62% of MFIs in Europe, Central Asia mentioned that low levels of digital know-how by customers is the key impediment to digitalization, followed by 52% of high cost. I mean, still, this technology is becoming more and more expensive, right? We think it will substitute manual processes and offer efficiencies, but this is not true because the whole world is progressing with technological transition, right? So certain issues become a hygiene factor, and systems get also complicated and require bigger investments to acquire these new technologies, and not necessarily those MFIs have these internal resources because they are trying to already cover high transaction costs and operate in a lean way to not to pass on this additional investment or cost to the final client. So an issue, really big issue, is being brought up, especially in the discussions in our region. How do we, close this digital divide? First of all, on the side of the clients who, micro enterprises, low income segments. I mean, they are the most excluded digitally. When we look at the transition of different sizes of enterprises, or when we look at the population, right? On one hand, on the other hand, the technology is becoming more and more expensive. We also have markets when MFIs are very small. So how do we find resources to finance this investment, and then not only finance but actually sustain, operate them in longer term, because it also requires ongoing investment. It's not like one-time lump sum investment to take. So this is a bigger issue, and this is coming out very strongly. Of course, we are thinking about some maybe pooling of resources, some platform solutions, but we are not there yet, so rather there is contemplation of how each of the MFI can access technology, and this is prohibitively expensive, how MFI can build capacity of the clients, which is, I would say, a broader problem, because it also depends on other digital infrastructure. If you cannot have digital signature anyway, you bring clients, 3 times to the office. Right. It's, it creates additional disincentive. Access to, government digital services is not yet there, right? So we should be also thinking more in terms of ecosystem, creating ecosystem for the clients, but also maybe thinking as an industry how to deliver this technology and close this technology divide to allow MFIs to access them. And thirdly, also, I think, which is really important, remember that many clients prefer this physical contact. So how we can offer some hybrid solutions that leverage technology, but are not, like we see, for example, in Europe, if you are you are a low segment customer, you are forced to use ATM. It has nothing to do with your preferences. You are just too expensive to serve. And even though you don't know how to do it, you are just forced to do it. And we wouldn't like to be put in front of such choices here when we work with those vulnerable groups that face so many different difficulties in different areas of their lives and operating their businesses.
So many things to dig into there, Kasia, that I could do a whole other hour just on some of these things, but I want to point to some specific things to really highlight. One is, so much of the conversation about the digital divide is about the digital divide to the customers and not the digital divide of the MFIs themselves. Second, the idea that technology cuts costs is not necessarily true unless you can get to scale, and often ignores the ongoing maintenance costs of those technologies. It's not just about buying the systems, it's about deploying them, maintaining them, servicing them, customizing them, updating them, and those costs don't necessarily go away or go down. And this is a particularly fraught time because everyone's probably noticed there's this inflation thing, and in the wake of inflation, interest rates go up, which means MFIs are caught in what's likely a rising cost of financing with a rising cost of operations to deal with the digitalization, ultimately with the hope of cutting costs down the line, but with no guarantees. Barbara, you and I have had some conversations about this, I think very similar to what Kasia was just mentioning about some work we're doing together in the Northern Triangle, that's Central America, for those of you who aren't sort of familiar with the jargon of this Western Hemisphere. And how MFIs are coping with this digitalization challenge. What are you worried about and hearing about that digitalization challenge in Central America?
Yeah, I mean, in Central America, I'll echo something that Kasia said about the smaller MFIs, right? They don't have the resources to tackle some of this stuff. At the same time, Central America and some countries in particular are a little bit more protected from oligopoly and large players that are attacking the region. And I'm saying that in a happy way, sort of, but, going into the region with these big brands, big products, and doing like mass market penetration, because that's a challenge in the Mexico, Colombia, Peru, kind of Brazil context, where an MFI or a smaller player with their own brand just can't compete. They don't have the brand recognition, they don't have the trust. And so they're challenged by a much greater marketing expense and capital expense there. So there are different challenges. Small countries, I think, have the challenge of cost and building the infrastructure or plugging into the right partnerships. And in these larger countries, you have these really big players, competing that are very challenging to compete with because of their brand recognition. It's a little bit different. One thing I will say in terms of cutting costs is that in my interviews with Sentinels, what I started to hear as they came down from the crazy rush to digitization was, well, it is more expensive to serve customers by including these channels, whether they're call centers, digital, et cetera, but they're betting on client loyalty. So they're actually seeing it more on, rather than on the expense side as a savings, they're seeing it more on the revenue side as a way to retain and increase revenues by having kind of more loyal, better served customers through like an omni-channel platform, rather than saying we're going to move you completely to digital, which is kind of unrealistic for so many of these players. So that is something that the larger institutions probably can handle, and the smaller ones less so.
Yeah, Dan, that does sort of weirdly connect to the long-term relationships in financing and things like how often are you going to reschedule a loan? How do you maintain loyalty? Because an important part of loyalty for a lot of MFIs is that they have a relationship with the customer and they understand and can make, like, the idea of microfinance is we can adjust. We're not just so totally rules-based, and if you can't repay, then we bring the hammer on you. The flip side of that is it's hard to tell sometimes the financial health of an MFI who's doing the right thing by rescheduling loans versus doing the right thing to make their PARs look appealing to investors. And so we didn't so much talk about like the financing state of MFIs and what their needs for recapitalization are, and will the historic metrics for what is a well-managed MFI apply for the next couple of years? Do we need to be thinking about a whole different, like, what is an acceptable repayment rate? What is acceptable PAR? Do we need to be thinking about those things?
Yes, I mean, I think that hasn't gone away. It certainly has changed. There's been a complete shift in understanding of what rescheduling is. I mean, rescheduling used to be a really rare practice. Some MFIs did it well, most didn't do it at all. Where now, like, everybody has done it, at least to some extent. So I think that that will change to, and I think for the better, to a practice where, okay, when you deal with clients who are really struggling, hey, you have this option, you've dealt with it before, it's possible. We've had one of the Sentinels, though, who kind of um, uh, saw issues with, they did what they felt was right on behalf of their clients and giving them sort of more leeway and more opportunity, and got pushback from investors because they weren't hitting the same profitability numbers as some of the other institutions in that country. So, it's not as though it's all, all happy days going forward. I think those pressures are there, and there's a real question as to what is social, and what should a social investor kind of expect from an institution in terms of numbers. I think one of the things that I found not at all surprising, but maybe interesting, if you look at, I'm working on a piece that hopefully will come up in the Sentinel in the next couple of weeks, but looking at a portfolio of an investment fund. It's anonymized and has about 80 MFIs that they tracked quarterly from 2018 up through end of 2021 is the latest data I have. And what's interesting is the single biggest predictor of the institutional's capital situation at the end of 2021 was, what was their capital situation going into the crisis in the first place? It was not par, it was not moratorium, it was none of those things. It was just those who had strong capital positions going into the crisis emerged with much stronger capital positions coming out of it. That's just a blanket statement, which is not to say that there aren't differences within those groups. Sure, they are. But I think going back to kind of a work that I had done outside of Sentinel, so this was the Weathering the Storm project with CFI, and we did a publication about a year ago, actually, kind of updating that work. And one of the things we looked at is, okay, if you look at, I think at the time we had, there was data on a bit more than a dozen MFIs, some of which had failed, some of which had survived crisis, all predating COVID. And when you look at the ones that failed, most of them had quite thin capital margins. So and it's not as though they had the most severe crises. If you look at their sort of par levels, or their sort of the level of crisis that they have to weather, may not be the worst, but they have a lot less margin to maneuver. And this is where it really gets into, the question is, will capital recapitalization go to institutions that are stronger? I think yes. I think that's exactly what's going to happen, because, whether that's the right thing or the wrong thing is separate question. But an investor, given the choice, is always going to choose to recapitalize somebody who's already stronger, rather than going for somebody who has kind of a weak capital position. There are always exceptions, but I think that's a really good lesson to relearn coming out of this crisis, which many have learned in past crises, which is, hey, have capital positions that are good. Don't try to, skim on, 12%, 15% equity, equity to assets. That's, it may be within whatever the requirement regulatory minimum an institution might be operating in, but it's not the ideal. It's when you get into the 20s, especially 25%, where you start seeing, okay, you got enough of a breathing space that you can suffer a really big impact, and you can also have more flexibility in what kind of responses you might offer to clients, what kind of investments you might be able to make for digital, investments or whatever. It's just having that capital on hand is valuable, and I think it's a lesson particularly relevant to NGOs that don't have easy ways to raise capital, right? That's not a thing, and yet to think about, okay, there was one NGO that I studied over the years, going back to 2008, which is a foundation to this day. It's still a foundation, and they actually, when they hit their initial crisis in 2008, what they did is they sort of focused a lot more on projects that attracted grant funding. they tended to be various types of technical assistance, working with clients in one way or another, and they actually use that grant funding to prop up their capital in effect. And that can be an interesting little model for an NGO, and I would really sort of encourage people going forward to really think about, where is my capital base? Because when your capital is thin, not only does, and it actually doesn't just affect recapitalization, it also affects the behavior of your creditors too. A creditor is going to be a lot more willing to extend a credit line or maybe renew it if your capital is in good shape. Whereas if you're really on a thin margin, you're going to see a lot more pushback. So that's just one thought.
Well, and this is a big deal, right, for the next couple of years, because MFIs have scrambled to keep themselves going, and the numbers aren't looking as good as we're used to. And I've had a couple of conversations with people who have said, during the last 2 years, all of our funders were like, oh, yes, of course, everything is fine. Your PARs are going to go up. We understand. But now as they enter into recapitalization discussions, they want numbers that look like they did in 2018. And, talking to MFI CEOs who are saying, did you want me to turn into a payday lender? I thought you had a social outcome, like either act like a social investor or don't. But, very much along the lines of you're talking, I had a recent exchange with Paul DeLeo from Grassroots Capital on some of these questions, and he was part of a group that got together, convened by Ira Lieberman at Lehigh University, sort of talking about the future. Paul, I did, I think, warn you that I might do this to you, so I'm going to attempt to promote you to panelists here, or at least allow you to talk. Let's see what happens when I try that. There he comes. Paul, if you can unmute yourself. There you go. Would love to hear some of your thoughts on the funding environment and what your concerns are.
Yeah, well, thanks. And just full disclosure, Tim did warn me he might ask me to make some comments, but we didn't coordinate on what those comments would be, and so he'll probably be somewhat surprised to hear that I'm actually not so sure that I would agree that he was wrong 2 years ago in calling this an existential crisis. Probably the first time I've agreed with Tim in quite a while. But I think what we're possibly seeing is a crisis that's unfolding in more slow motion than we anticipated. I think 2 years ago, Ira Lieberman and I wrote what in retrospect seems like kind of an alarmist piece about how urgently the industry needed to get together to come up with coordinated actions, and how I think the subtext of that piece was how unlikely we thought it was that the industry would come together. I think we've been happily proven wrong on that. But I think the sense in which I think this is a bit slow motion is some of the things that you all have touched on, which is who's going to get the capital. I mean, I think if you look at the existing suppliers, particularly of social, what we might call social capital, it's clear, and you're talking about the MIVs and even the DFIs, it's clear that there's not going to be enough equity to go around to reconstitute the balance sheets. One of the things and one of the reasons why I think this is a slow motion crisis is that it's still not clear in many countries what the impact on equity is going to be. The good part of the moratoria and the regulatory forbearance is that it's enabled everybody to have time to absorb and react to some of the impact. But the bad news is that we still don't know what the magnitude of the impact is going to be. But it seems fairly certain that it's going to be larger than the supply of fresh equity that's going to be available. And again, particularly from social investors. And this, I think, is going to accelerate a trend which has been underway for quite some time. And as a trend, be careful what you wish for, that we've all hoped would materialize, which is the balance sheets are being built by non-social investors, by more commercial investors who have much deeper pockets, which is a great thing and what we all hoped for. but it's accelerating a trend of the diminution of the influence of social investors and the sort of trend towards commercialization for better and worse. And I think what that translates into in the current circumstance is that, quite understandably, as some of you mentioned, investors are going to favor those MFIs with stronger numbers. And there's going to be a potential for a shift away from some of the more difficult to reach, some of the MFIs that sort of take on more struggling populations, or that innovate products, trial and error, to design products that are appropriate for those populations. So I think, existential crisis, maybe not in terms of the existence of a microfinance industry, but quite possibly existential crisis in the sense of a shift in the character of the industry. So I think, Tim, you're at least half right as of 2 years ago.
Very kind of you, Paul. Thank you for that. I would say, though, too, that this is the history of financial services for the poor. And I don't mean like from 1980. I mean from 1880 and 1780 and 1580 and 80. That it's not as if a need for finance among low-income populations only emerged in the modern era. It's that it's hard to deliver these services sustainably. Pressures get put on, and the people who are serving the least profitable customers go under, and then it takes a generation before somebody tries again. And that is absolutely a worry of mine, is that we see that, the example I often trot out is the credit union movement was essentially microfinance in the 1850s, serving rural customers that were way too hard to serve. And it worked for a while until there were massive disruptions in agricultural environments that drove a lot of those credit unions out of business. And then we had to start again. And I worry particularly about rural customers with the digitalization wave, and those harder to serve urban women that are less profitable and will always be less profitable. Thank you so much for bringing that in, Paul. And I think some of those comments I'm actually going to attempt to bring in another person. Paul, I'm going to do something crazy, and I'm going to hit a button that says remove, which I hope sends you back to where you were and doesn't just like boot you. So my apologies if it does. So I'm going to hit that. Oh no, I don't want to do that. It does warn me. So Paul, I'm just going to ask you to turn off your video and mute yourself so I don't lose you entirely. And I'm going to go over to Joyce Klein. So Barbara talked before about wearing some different hats. I have a different hat working with the Aspen Institute's Business Ownership Initiative, which focuses on US microfinance, which is quite different in many ways from the global context, but actually also has a lot in common. And Joyce, this conversation about who gets capital is pretty important in the United States, because it's very clear in the United States that commercialization is not really an option for people who aren't to serve entrepreneurs of color and the least served. So here I'm attempting to promote Joyce. We'll see if she pops onto our screens here in a second. With the question of what have you seen in the United States about making sure that the organizations that actually want to serve the underserved have the capital access necessary to be able to do that?
Right. So Tim, first of all, this has been really fascinating. And I will say, there are some things that are very different about microfinance in the US, but so much of what people have been saying today about digitization of MFIs, and we see, exactly some of the same issues in the US. One thing I will say about who's getting access to capital and what's happened in terms of the financial strength of MFIs in the US, there are a couple things that I think are really different in what happened here. And I would say there's two I want to point to. One is that the pandemic happened, but at the same time, or around the same time in the US, we had this reckoning around race, which was created by the murder of George Floyd, on top of many other experiences that folks of color had because of officer-involved shootings or shootings of folks. And just a lot of reckoning around race in the US, which compounded the fact that traditional, often government relief programs didn't get to certain kinds of small businesses because historically they've been run through the banking system. And so what happened in the US was that there's a reckoning in race, and we had an initial sort of set of relief programs, particularly the Paycheck Protection Program, which funneled money to small businesses, did it largely through the SBA and banking infrastructure, and wasn't reaching the smallest businesses, the most underserved businesses, businesses owned by people of color in the US, and businesses owned by women. And so then there became a focus on the role that MFIs and other community-based financial institutions played in reaching those populations. So I think one of the things we've seen coming out of that in the US is that there's been a lot of equity that's flowed to this sector, to the MFIs. And so balance sheets right now for these institutions are pretty strong. The other thing that I would say, just based on the stuff that Daniel was saying, is that in the US, the investors, the folks who are creditors to microfinance, have been more conservative. So you do not see a lot of CDFIs with 12 or 15% equity layers. Like, many of the investors require 20 or 25% net asset ratios, which has made scale hard because it's not that easy to raise that equity, but probably means people had a stronger layer going in. So that's different. The thing that I would note that's so I don't think there's like an equity issue for CDFIs right now. What I do think there maybe is a revenue issue, because I think what we saw was a lot of relief, grant programs, forgivable loan programs, very low cost loan programs directed at small businesses to help them get through the crisis. A lot of that happened. The MFIs engaged in that. They did that, was off balance sheet, and they got paid origination fees to create those loans, to originate those loans. And they basically stopped lending off their balance sheets. And in some cases, folks who got a PPP loan used that money to repay their loans from MFIs. So now all of a sudden their portfolios are shrinking, and we're seeing a change in the nature of demand on some level. So you have the businesses who have made it through the pandemic but are weaker and are thinking about whether they want to take on more debt, are used to like free or no cost debt in an inflationary environment. They don't want to pay the interest rates that they were paying MFIs before, or they're thinking about that. And then in the US, the other thing we've seen is a ton of new startups who typically weren't a big customer base for a lot of MFIs that were doing a lot of scale, and are clearly like, need different products, different ways of underwriting, different risk levels that CDFIs or that MFIs are trying to serve. And so there's lots of questions about like, where's my revenue going to come from over time, and how much do I need to invest to be able to bring on or serve those customers, or manage risk or reduce my interest rates so that I can meet the demand that's out there. So that's the way I differentiate what we're seeing in the US.
Thanks, Joyce. And that actually provides a bridge into sort of the wrap up. Like always, suddenly I look up and, oh my gosh, so many more things to talk about. But I'm going to, give Kasia, Dwijiraj, Barbara, Dan, sort of, here's your warning to like your 3-4 minute wrap up. What are you thinking about over the next couple of years? But I'm going to quickly kick this off, building off of some of the things that Joyce said. Is the shape of demand is changing. And I think to put that more broadly, the business model of microfinance is having to adjust rapidly. And that matters a lot, because part of the reason that microfinance has been so successful, what really changed in the 80s was the discovery of a low-cost business model. And part of that was a cookie cutter business model that was pretty easy to implement. And you could start up something new with people who understood what the product was. You didn't have to sort of like go and teach all these social investors about lending to the poor. People understood what you were doing. You didn't have to have the most sophisticated CFO in the world, because you had a single product that operated exactly the same and was relatively easy to account for. you could hire and train people relatively cheaply because it was a rules-based, very well-defined system. We are now entering into an era where inflation and costs of capital are rising rapidly. That's a big challenge to manage through. Your operations with digitalization suddenly require a lot of different expertise and additional costs to get yourself changed. And business model transformation, technology only pays off if you change your business processes to take advantage of the technology to lower your costs. You can't just buy something and suddenly expect your operational costs to go down. And the job of everybody in the organization, especially the loan officers, is changing. I'll commend to everybody a post on the Sentinel Project from Lisa Spontig and Christina Sura, who were documenting some of this among loan officers in India. And the pressures of, now I actually have to negotiate with clients. And I don't like putting pressure on them, and I don't like negotiating with them. I liked my old job where there was a rules base and everybody understood it. And now the job is changing and it's getting harder. That puts a whole other level of pressures on MFIs. And when I think about the next 2 years and think about the variety of challenges, even if we don't get new evolutions of COVID that can become more contagious or create other problems, the challenges of the next 2 years, I think, are every bit as daunting as the challenges of the last 2 years. They're different, and it's about change in the industry. And that's going to require this concerted effort. It's going to require the networks like EMFP and the Microfinance Center to have MFIs learn from each other. It's going to require some of the networks that Paul was talking about in these agreements, and Dan was talking about these agreements. How are we going to manage this? And it's going to require people to continue to recognize, if we don't provide support to the microfinance industry, the people who provide services to the poorest and most vulnerable are going to go away. Period, full stop. They're going to go away if we don't take the next 2 years as seriously as we took these last 2 years. So that's my parting shot. Kasia, what do you think about as we close out and thinking about the next 2 years?
Yes, I mean, we are actually forgetting about the pandemic altogether, even though we know it became a part of our everyday life, because we have the war, you know, across the border, and everybody is already affected directly or indirectly by the war in Ukraine. So we see what you mentioned, inflation, post-pandemic, and all this printing of money, of course, influence, but also, you know, very high energy prices impacting all aspects, all sectors of operation. We see members coming and saying, you know, our cost of capital within overnight increased 3 times, for example. Like I was just talking few weeks ago with a member from Romania, especially those countries which are not, you know, linked to euro, right? And the euro, you don't yet experience that. We have, you know, the whole Central Asia dependent on remittances from Russia, now cut out of big part of incomes coming. So like I'm just today, I got first tentative data from our annual survey, and the main concern of the MFIs is client income volatility. So as we mentioned, the businesses are weakened after the pandemic. Now they are being weakened by another crisis, even if they are not like directly affected, but also many businesses are directly affected, or families not receiving these remittances. So we need, you know, another, I think, round of heads up. We already started to talk with investors who apparently also are thinking about issuing a similar pledge or MOU on how to treat, how to address the issue of this impact, which is a different type of impact, of course, currently, and affecting different MFIs in different contexts to different extent. And my hope is that all this learning from the past crises, we can use it, you know, for the benefit of protecting the sector that we've built over these years. You know, it would be, I always remember your presentation, you know, coming back with microfinance being reinvented every century again and again. And I hope we will find a way not to, you know, come to the point where everything will stop, and then again we will have to build the industry from the scratch. And I think there are many factors currently putting the industry at risk, and many of those we don't even know the longer term impacts, as we heard from the pandemic, or I mean the war is still ongoing, you know, the energy, the whole system for energy supply, at least for Europe and this part of the world, is changing, but also food crisis that is expected in Africa, right, in other parts of the world. The whole green transition with also additional costs for the small clients, and how do we go about it, how also the FIs are addressing it, and different stakeholders. I think we have a lot of these mega trend issues like digitalization and the green transformation that also, you know, increase this divide, especially with the small holder organizations and MFIs. And then we have macroeconomic and different crises that are everywhere in the world, right? So we have to find, again, put our heads together. And I think this agile approach that we use in the pandemic, coordinate, learn and improve. I think this will be really even more critical, you know, going forward with the long-term slow crisis, which is, you know, we always think, okay, we can do it tomorrow, but actually not, because the impacts, potential impacts, are really big and on different levels. So calling for a group, you know, to think through those new challenges, you know, maybe new Sentinel project, but with new challenges ahead, right?
We certainly don't have a shortage of topics for conferences. Dan.
Yeah, so I really would totally second what Kasia was saying. I actually wanted to focus on specifically a crisis that I think will start hitting in a very, very serious way this year, which is the high cost of food. Kasia, you mentioned this, but I think some countries are very exposed to it. I think the impact will be much larger than many of us expect, and it's probably not going to be, well, in some ways, much like COVID, where you had very heterogeneous impacts in different countries. Some countries, even those that border each other, you know, one actually is doing very well, another one is really struggling, and we've definitely seen this. I think we could see the same from this change with combination of high energy prices, you know, deficits potentially in food availability, and the one thing that makes this all harder, this is coming on top of just as institutions are starting to emerge from an existing crisis. So that all of this idea that, okay, well, you know, I think this improvisation, this ability to continually reinvent and come up with innovative solutions will continue. I also think that the importance of at least communication, and be it investors, being other sort of cross national, you know, transnational organizations, bringing people together will actually be important, because this is how, you know, when you need to react quickly to a quickly developing problem, it sometimes needs to go beyond the borders of the country involved, and certainly beyond the institution involved. So yeah, I think operating in crisis is something that's very much going to stay with us, and that's maybe the one thing that we can come out of COVID and say, look, this isn't going to end. Maybe not all that optimistic, but it is what it is.
Gujaraj?
I think I'll just structure it in a chronological manner and start from clients. I think what's happening in India is that the impact on clients right now is going to be substantial and quite significant. We see folks going back to places where they used to work, food prices are rising, and with the new laws and new regulations that came about, there is actually no more interest rate cap. So even if the central bank raises your interest rate by 1%, cost of funds are going up by 2%, the end user is now most likely be charged in the range of 3 to 4%, because all the interest rate caps have been removed with the new regulations in play. And at the same time, what has happened is that the qualification criteria for who is a MFI, who can be an MFI borrower, used to be around 180,000 rupees. has now has all of a sudden become 300,000 rupees. So we have seen that. So what's going to happen is that the poorer segment and the lower income segments who were earlier being serviced will slowly start falling off of the MFI bandwagon, and the MFI client base is what the expectation would be. And we start, so earlier also skimming the top of the lower income segment was there. Right now, we will just see the lower income segment expand, and we will see newer clients emerge, entering, and newer, relatively higher income clients sort of entering and becoming individuals entering the clientele. So that's one transformation that is to be expected. And the second transformation that we are sort of expecting is digitization is here to stay. Like, I realize that operational cost, etc., is high, and often you cannot really leverage that the benefit until and unless there are business process transformations. Absolutely agreed on that. But the problem in India is that it's not only the MFI community, but for also the regulators, digitization has become a silver bullet of sorts. So there is a regulatory push that anybody with more than 10 branches needs to have something similar to a core banking system. So at the moment you're forced to have a core banking system, adding one more layer is not really that expensive. The cost that the MFI ends up incurring, whether in terms of CapEx or OpEx, is not really that significant. And therefore we see that digitization will remain to a great extent. But the biggest concern I would say we have to an extent is, in light of these, what happens to the client? What happens to the client is, A, we are seeing the traditional customer base disappearing because they cannot simply afford to pay the high cost of loans. But at the same time, what happens to the ones who are not really a part of the digital system? And that's a worry that, and with it, of course, comes the entire slew of privacy concerns, etc., and how lower income individuals are particularly vulnerable to certain types of fraudulent attacks, privacy breaches, etc. So those concerns remain at the client level. Finally, I'll just end with the capital position of MFIs, because what we saw during the pandemic was that there was a move towards the collective. Everybody was trying to help each other out in as much as possible, because at some level there is this reputational risk that can manifest, that if one MFI fails, investors might just pull out from the entire sector, that because the sector is unstable. But the moment we move away a little bit and the balance sheets, the PAR numbers, etc., sort of stabilizing a little bit, then does the collective survive? Or are we then leaving the bad PAR numbers, the bad capital numbers, and a PAR of greater capital adequacy folks, 20-25%, etc., they are only being the beneficiary. And the moment they are the beneficiary, the impact is again on the clients, because they generally will serve the creme de la creme within the low income segments.
Barbara, last word.
Okay, so mine is just kind of a compilation of everything we heard, but I'll try and frame it a little bit differently, just to say something different. But I would also start with the clients. I agree, and I think that this impact on demand, the lower demand in general, what it shows, at least in Latin America, the MFIs, is they can't lend large amounts right now. They need to reduce the loan amounts in order to maintain some kind of prudence. And as such, will skim from the top as well and be lending to the better, stronger clients in small amounts. What that means, in my opinion, is farmers are going to be cut out. They've benefited from the pandemic, and they're going to start to be cut out because their input prices are going up a lot. They're getting squeezed. They're much riskier today than they were 2 years ago. So farmers are a big problem. And going back to Dan's point about food security, that's a significant issue. The most poor and most vulnerable will be excluded because they're harder to reach at those smaller amounts, and not necessarily worse payers, but certainly harder to reach. And the people who need more than $200 or $300 are going to have to find other ways to piece together the $2,000 they need, which means they'll take a consumer loan, a digital loan, a microfinance loan, and suddenly we're going to have this messy fragmentation that's hard to regulate and supervise. And we go back to consumer protection and the risk of over indebtedness with these fragmented solutions that we were seeing maybe a decade ago and are going to go back to. And I'll wear my, and that is hat here and say, women are getting pushed out of this sector as managers, as leaders, because we're moving into prudence and risk. And those are traditionally things that men do. And because of where the capital is coming from and being concentrated in, that are these big financial groups that have the capital to support the large institutions. So we're seeing kind of a masculinization again of the sector, similarly to 10 years ago. And I see that as incredibly risky as well, because it means that we're not going to be thinking about women, women's needs, some of the social issues that are out there. And that's not to say there aren't men who do that. And it's not to say only women do that. But the type of profile that is being brought into the management is very different from the profile we want if we want to ensure kind of a more equitable distribution of resources. So that's my concern today.
Well, I scheduled an hour and a half and somehow we blew through that even still. And I wish we had another hour to go delve into these things. I hope all of you who have joined us have found this as fascinating and enlightening as I have. We will have follow-ups to this. Colin, we've sort of answered your question, but we will add some more to that. Please do feel free to follow up with other questions. There will continue to have a debate on these things and some resources available on the FAI site, which you can see some links to there to subscribe to hear about future faiVLives. I promise I will resurrect the Five weekly newsletter at some point, but the best way to hear about future faiVLives and get access to these resources and recordings and transcripts is to follow us through the things you see on your screen. Finally, let me thank especially Dwijaraj, Barbara, Kasha, and Dan for doing this with very little preparation and very little advance warning from me in the first place, and very little guidance from me along the way. I knew I could trust them, and they have come through with flying colors. So thank you to all of you for being so thoughtful, so being engaged, and we will look forward to more conversation and being part of solutions that guarantee that excluded populations do have access to the quality financial services that they need. Thanks everyone for joining us, and we'll talk again soon. Take care.
Thank you.
Thank you.
Thank you.
Thank you.